Welcome to Under One Roof MTL, where we are demystifying home ownership one episode at a time. I'm Robin Flynn, joined as always by Martin Spalding from Fred & Martin Mortgages. Good afternoon, Martin.
Happy Sunday.
Happy Sunday. Also joined by LJ Aguinaga of LJ Realties. What's up, LJ?
How you doing?
Pretty good, pretty good. The weather is the weather. It's November. I was looking at so I have a smart thermostat at home, and I can see every month how much heating and cooling I have used. And I still have yet to use more heating than cooling. And it is mid-November. So all of September, all of October, I used more cooling than heating. That's not normal, guys. I'm a little concerned.
You know the best way to describe the weather in November? Dark. Just dark.
Even when it's sunny, it doesn't last very long. No. Sun starts to set super early.
Yeah.
Okay, let's start with our trivia question of the week before we dive into some of the stuff that was in the news. So this is brought to you by Felix and Norton Cookies. You can visit their store at the Blue Haven Shopping Center, 3705 St. John's Boulevard in DDO. If you're the first person to text in the correct response to 514-790-0800, you'll receive delicious cookies delivered straight to your door. Our question this week: what is the process of multiple buyers competing for a property, potentially driving up the price, commonly known as? If you think you know it,
we don't get these questions.
0800.
We don't get these questions in advance. And so when you read them on Sunday morning, I sit there and I go, wow, that's a good one.
Oh, well, thank you. I appreciate that. Guys, there's so much in the news this week for us to chat about. The first one that really caught my eye, the upcoming rise in mortgage renewals. We spoke about it last week. 1.2 million Canadians have their mortgages coming up for renewal in the next year. Could this trigger an increase in property listings as people potentially discover they can't afford their mortgage anymore and they decide to sell? LJ, what do you think?
Look, that's definitely one of the options. And the closer we get to 2025, I think the hotter of a topic this is going to be. It's on everybody's mind right now. What will end up happening is obviously going to be a question of, are we going to give up the extras in life, the vacations, the additional spending, maybe that berry budget we're going to have to cut into, unfortunately, or are we going to choose to stay in our house and obviously cut out those things, or are we going to choose to go down a rental, sell the property, take whatever equity we have in that property, live off of that for a little bit, and try and get back into the market in a couple of years. But as Martin pointed out, next year, there's a good chance that if you sell now, you're not getting back into the market, because as prices continue to rise, if you can't tighten your belt today and adjust to the current situation, then it's going to be very tough to play catch up.
The other factor that's coming into play is that, as we've said time and time again, fixed rates are influenced by the bond market. And it seems like if you listen to the economists right now, that fixed rates are starting to level out. And a lot of people were waiting for that sort of indicator to get back into the market. There's been a lot of people sitting on the bench. And now what we're hearing from economists and what we've been seeing actually is an uptick in fixed rates because bond yields are ticking up as well. So, I mean, we talked about it last week about how variable rates are becoming more viable, more appealing, because those are directly attached to the Bank of Canada lowering its interest rates, whereas fixed rates are attached to the bond market. So what the economists are saying is things are starting to level out. So if you're a fixed rate person, you're going to get into the market now because they're not going to get any lower. And a lot of people are afraid that the benches are emptying, the ice surface is getting full, and what's going to happen is you're going to get back into that scenario where a lack of inventory, multiple offers, driving home prices up. So they want to nip that in the bud, and they want to get into the market sooner than later, knowing that if they're a fixed rate type of person, they're not going to get any lower. So I may as well get into the game.
But variable rates continue to fall, right? We still have one more announcement from the Bank of Canada before 2024 is through, and people are predicting another rate cut, right? That's what we're expecting for now.
It's funny because, you know what, 2 weeks ago, everybody was betting on another 50 basis points in December. And now people seem to be pulling back on that slightly. And the gap between variable and fixed right now is about 75 basis points. So if you want to be on the plus side of the ledger and you want to hedge your bet, we still think that knowing the fixed rates are probably going to stay where they are over the next sort of 18 months, if you're willing to hedge, I think that now variable rates are getting more and more interesting. Now, no one's got a crystal ball, mirror ball, crystal ball, mirror ball. No one's got a mirror ball. So we can't predict what's going to happen. But if you listen to what the experts are saying and the economists are saying, more than likely that 75 basis points gap is going to be eaten up by June or July of 2025. So you may pay a little bit more if you sign your mortgage today, choosing a variable rate, but you'll be on the winning side of the ledger post July 2025.
I also read an article this week that talked about this idea of a mortgage war. Are the lenders going to have to start competing with one another to try to get people's business? I mean, that would be great news for the consumer, for the borrower, right?
So this is really exciting. I'm going to jump in here because every year we see a mortgage war start up, usually in the spring. It's when there's always a bank or two that want to differentiate themselves. They're going to come in with the most aggressive pricing because they want to put a lot of mortgages on their balance sheet that year. Now, obviously, with the phenomenon that we're about to walk into with, I think, the 1.2 million mortgages that are about to renew in 2025, this leaves an excellent opportunity to come in and jump into this mortgage war that we're discussing. At the same time, the government has changed the rules a little bit, stating that if you're just looking to maintain the same amount, obviously, and not change the term or the amortization of your mortgage, then you no longer have to go through a stress test if you change institutions. So by doing that, we've now opened up the gates of people being able to transfer mortgages from one bank to another, maintain the same debt amount, maintain the same amortization, but go to any bank that's actually offering them a better rate, which is really interesting because we're obviously concerned about how people are going to qualify for this next mortgage.
And if I could add to that, there are other factors that are starting to influence the banks. So limited growth abroad and a thing called open banking, which is on the horizon. So what is open banking? We see a lot of that in the United States. There are a lot of apps, sort of like, I'll give you an example, Robinhood, which is a trading app that links the bank accounts, letting users trade stocks, ETFs, and crypto without paying fees. Now, why am I bringing up Robinhood? Because Robinhood was in the headlines because Robinhood is that app that drove GameStop stock to new heights in 2021. So what it allows people to do is it allows to share their financial data with companies outside their bank. It allows people to use new apps to track spending, make budgets, compare loan rates. So what that's going to do is it's going to give a lot more power in the hands of the borrowers, and hence the banks see an increased amount of competition, and these types of apps will break up the big bank oligopoly. And so they're concerned that in the next couple of years, all these new apps and all these new financial services are going to start eating their lunch. So they want to tie down and get as many mortgages signed for the longest period of time possible to protect their share or the share of the market.
I see commercials for these kinds of apps all the time, your Wealth Simples, all those kinds of things. And they are so smart with their marketing where they are really targeting young adults. You know, this isn't your grandfather's banking. It's very, very young and dynamic, which I think will be appealing to young adults who are trying to get ahead. LJ, I want to ask you before we go to traffic, I saw an interesting story this week about office real estate. So specifically, lots of people working from home still, despite the push to try to get everybody back into the office. People are resisting very, very strongly. At the very least, there's some sort of hybrid scenario. I know very few people who work 5 days a week in the office, but presumably this would mean that there's a lot of office space up for grabs. I guess people aren't renewing their leases. So what are we seeing right now with office real estate?
So in terms of office real estate, over the last 2 years, even 3 years, really since the pandemic, we've seen a lot of offices become vacant. And you have a lot of people who've shifted to the work from home model, the hybrid model, etc. So because of that, a lot of companies have recognized the fact that they don't need to have 20,000 square feet, 15,000 square feet, et cetera, et cetera. So you have a lot of companies that are choosing to downsize. I mean, we have an example, a perfect example here, Deloitte, when they built their new tower, which was actually even before the pandemic, they built it under the hybrid model where nobody had their specific desks. Everybody kind of used floating desks. And we knew that this was going to be the trend where things were heading. National Bank also built a new tower up on Robert Barassa, and same idea. They built it with that concept of we're going to be using flexible time. Not everyone's going to be in the office at all times, so we can go with the flex space. So we've already seen people kind of transition to the idea of flex space. And obviously a smaller company is going to say, hey, well, I don't need 20,000 square feet. We don't need 17 boardrooms. We just need to have maybe 3, 4. And we need a space where X amount of people can work, because usually you'll have maybe the finance department in one day, the marketing department in another day, and mix mash in that sort of sense. So what has this led to? Well, it's led to a lot of opportunity in the subleasing category. We have a lot of young companies that are looking for office space, not much, maybe 1,000 to 3,000 square feet. And they're getting these excellent deals on subleases from companies who signed longer-term leases, who are stuck with this lease right now, don't need the space, and are happy to give off a portion of that. I have a couple of friends who've actually taken advantage of some of those opportunities. In the long term, where do we see this? Well, I've spoken to a couple commercial realtors, and one of the options is, do we turn these office buildings into residential towers? And we've started to see some office conversions into residential towers, because obviously we have a huge shortage of supply when it comes to residential housing. On the other side of the coin, we are seeing more and more people start looking into office, dabble their feet. They're not looking for as much space, but they still recognize that they need some sort of space, a central place for a lot of their operations, for some of the bookkeeping, all that back-end stuff, if you will. So we are starting to see demand start to climb slowly, and these landlords are adding more and more perks. So you have people bringing in, I know in Toronto, for example, a Milos restaurant opened up on the ground floor of a beautiful office tower, right? And they're making this kind of a central attraction for some of their offices. You have buildings investing in these awesome gyms. People say, hey, come to the office. You don't need another gym membership. You can use the gym in here. Maybe we're going to leave the top floor as a penthouse with excellent views. It's going to be an open area for people to read, for quiet work, etc. So they're changing the game a bit in that sense in order to attract people back, in order to get people to sign these leases, because obviously these are long-term, expensive leases that people have been signing, and everyone's just readjusting to the new reality.
I like these creative solutions. I didn't like the approach. I feel like in the last couple of years, it's time to go back. You're not as productive at home. There was a lot of shaming. Incentivize people to want to go to work. That's how you're going to get people back in the office, right?
Well, let's face it, most employers don't have a choice. Now that employees have gotten a taste of working from home and not having to get in the car, driving an hour in traffic, they have no choice if they want to attract or retain their employees, but to adopt a hybrid model. And on the plus side of that, they've also seen, well, we need less space, and it's reducing costs. So I think it's a win-win for everybody. I know there are some companies in the United States have said we're coming back to a 5-day work week, but I just don't see it anymore.
Makes a lot of sense. For all of your mortgage questions, make sure you get in touch with Fred and Martin, by the way, over at fredandmartin.com. Coming up, what are the pros and cons of fixed rate mortgages? We'll find out after we check traffic at the CJD 800 Traffic Center.
What are the pros and cons of a fixed rate mortgage? This is your Mortgage Minute. A fixed rate mortgage keeps your interest rate the same for the entire loan term, making monthly payments predictable and stable. This is helpful if you like knowing exactly what you'll pay each month and want protection against rising interest rates. However, fixed rate mortgages usually start with a higher rate than variable ones, so you may pay more if rates stay low. Additionally, if you want to break or refinance the mortgage early, you might face high penalties. Fixed rate mortgages are ideal if you prefer stable payments and expect to stay in your home for a long time without big financial changes.
This is Under One Roof MTL on CJD 800. I'm Robin, that's LJ, that is Martin. The pros and cons of fixed mortgages. I feel like this is the eternal dilemma with homeowners. Do I go fixed or do I go variable? And it all depends on a variety of factors. There's no easy answer. It depends on your situation. It depends on the interest rates. It depends on so many things. But there are probably a few pros and cons that we can really discuss here that would potentially be universally applicable. So the Mortgage Minute really, teed things up nicely for us here, but let's dive in a little bit more. What are some of the pros and cons of, for example, a 10-year fixed mortgage?
So the pro, obviously, is that if you're looking for stability over the course of the next 10 years, you get that with the 10-year fixed. You don't have to worry about what's going to happen in the economy for the next 10 years. Now, 10 years is a long time, right? I know Fred usually tells us that 7 out of 10 people do not come to the end of their 5-year mortgage term. I wonder what the numbers would be on a 10-year, obviously. Now, we don't have a ton of data because not a ton of people take this 10-year option. But if I kind of extrapolate that, I think it would even be closer to maybe 19 people won't come to that 10-year term, just given the fact that things change, obviously, over the course of 5 years and even more so on a 10-year term. So the pro is stability, 100%. The con is, Well, if we look at the penalties and we're looking at interest rate differential and we're looking at a potential having 8 years left on this mortgage, obviously a lot of runway left on it, the banks are going to want to get paid on that differential for that period of time left. So you really got to be sure that nothing's happening. No one's going anywhere with this property.
Yeah, 10 years. I mean, I was reading about that represents about 2% of people who are signing for mortgages. So it really is a different mindset. So as LJ mentioned, some of the pros: steady interest rate, steady payment for 10 years, protects you against interest rate hikes, reduces the need to renegotiate after 5 or 3 years or whatever term you have signed for. The cons, usually 0.5 to 1% higher than shorter term mortgages, breaking the mortgage before the 5-year term or 5-year or the middle of the term can be very costly and comes with huge penalties. And also, as LJ mentioned, 10 years is an eternity in someone's life, especially if you're just starting out. You know, are you going to meet somebody? Are you going to get married? Are you going to have kids? Are you going to outgrow the house? What are you going to do? So currently, if we look at insured 10-year fixed rate mortgages, they're at about 548, when we're seeing 5-year at about 448. Conventional mortgages for fixed are about 563, and we're seeing about the same thing, a point less for 5-year. But I wanted to bring up this point because this doesn't exist in Canada, but in the U.S. you can sign a 30-year mortgage. 30-year mortgage. And the current interest rate right now is 6.79. But during COVID, for a 30-year mortgage in the United States, you could have signed it in the mid-2s. Imagine if you pulled the trigger on that during COVID. You'd be sitting pretty if you want to stay in your house for 30 years.
There's an important differential between the U.S. and us. And after the crisis in 2008, there was a regulation that came in that stated that you are not allowed to charge prepayment penalties in the U.S. Therefore, it doesn't matter, because in the U.S. you can sign a 30-year mortgage, and after 1 year you can get a new mortgage with somebody else, change it, and you can switch banks as many times as you want in that sense. Obviously, there's some general fees associated to changing banks, but there is no prepayment penalty. There is no interest rate differential. So because of that, it's a much more viable option, because I think a lot of people in their mind would have been thinking, oh, but I hear about this 30-year term in the U.S. Why would 10 years be so bad in Canada? And the big differential is that prepayment penalty, which is night and day.
Yeah, what would be a scenario where it would make sense for somebody to take a longer term on their mortgage?
Oh, it's really a mindset, I think. You know, I think if you're a conservative person and you actually have mapped out your life plan.
Maybe you're single, so you don't have to worry about a breakdown of your marriage.
Exactly. I mean, there are so many variables there. But I can tell you, like I won't mention my age, but if I had taken a 30-year mortgage 30 years ago, I would have never considered it 30 years ago. But my life and who I am today, 30 years later, is significantly different than when I was 30 years ago. Younger. We'll call it younger. Thank you. So I agree with LJ. I was not aware that there are no prepayment penalties in the United States. So it makes perfect sense, you know, to jump on something like a mid-2s 30-year fixed rate mortgage in the States if there are no prepayment penalties, because you got nothing to lose, right?
So why didn't everyone in the U.S. hop on that? If there were no prepayment penalties when they saw the 2% interest rates, did they all just cancel their mortgages and switch?
I don't have the data, but it'd be interesting to see the data on that, though.
A lot of people were refinancing at that point in time. Everybody was taking advantage of that because, yeah, if they were at 4 or 5, 6% or whatever, again, there were some costs involved. So if you were at 3.5, maybe it wasn't worth it. But anybody who bought during that period, or it was time to refinance, 100%. A lot of people took on new mortgages, and that's actually what's led to the people now feeling like they can't go anywhere. Because porting is also different. They don't have the same porting rights that we do here technically. So you can take over someone's mortgage on a property, but you can't necessarily port it the same way as we can here. So because of that, people feel trapped in their house and they feel like they can't go anywhere because they're paying so low for this property, which has started a new phenomenon. It started a lot more people becoming real estate investors who weren't intending on it originally, but they got a house, they got a great deal on it at the time, they have a super low interest rate, and they can convert it into a rental super easily because the property's going to cash flow. When they're paying 2% interest on it, and based on how much real estate values and rental rates had gone up in the U.S. as a whole, it's okay, convert that first property into a rental, get a new property wherever you want to go and start building your little portfolio passively and start growing that real estate machine that you can have in the background working for you.
To find out more about what your lending options are, get in touch with Fred and Martin at fredandmartin.com. Still to come, why do so many young adults feel that home ownership is just unattainable? And are they right? We'll find out after the news. You're listening to Under One Roof MTL on CJD 800. I'm Robin Flynn, that's Martin Spalding, and that is LJ Aguinaga. Oh boy, many young adults feeling home ownership is just unattainable. But is it actually? I feel like a lot of my friends anyway are pretty pessimistic. The ones that aren't already homeowners have sort of resigned themselves to renting for the rest of their lives. They're like, meh, yeah, I'm never going to own a home, which is sad. It is really sad because I think that's something that most of us dream of when you grow up, that you're going to get married, have kids, and own your own home. But the latest Scotiabank housing poll found 55% of millennials and 58% of Gen Z feel that home ownership is unattainable. What's interesting, though, is 1 in 4 of those young adults actually feel confident in their knowledge of what it takes to buy a home. So they think they can't buy a home, but they also don't know what it takes to buy a home. So what can we be doing to better educate young people? Because I think for a lot of people who think it's unattainable, they're just being pessimistic. Perhaps there are options, right?
Well, I think you need a plan, right? You just don't wake up one morning and go, I want to buy a house. And I agree with LJ. You also have to, what are your opportunity costs? So what are you willing to give up to actually get into home ownership? And also, you don't have to buy, your first home doesn't have to be your dream home, your forever home. You just got to get into the market and start building equity and start paying down your mortgage. And so, and the best ratio for purchasing a home is to stay in it, 5 to 7 years. Because a lot of people go, well, I'll flip it. Well, you remember that you paid, the famous welcome tax and the closing costs, and you did some renovations. So if you flip it right away, unless it's a flipper, if you flip it right away, you're going to lose money on the investment. So your first property, you should stay in 5 to 7 years, then take the equity that you've generated from that property to purchase your next property. And slowly but surely, you sort of upgrade yourself. In the same breath, you hope that your career is on track. So slowly but surely, you'll start earning more money. You'll be building equity in your home. And sooner or later, you'll end up in that house where you'll be willing to sign that 10-year fixed rate mortgage or that 30-year fixed mortgage because you have found the right one that you're willing to settle into.
I think a big part of this comes down to planning and budgeting. I've worked with a ton of first-time buyers, young buyers. I have clients who are working at restaurants. I mean, for example, I'm meeting with clients later today that bought a house in Vaudreuil probably 6 years ago now. At the time, they were both working at Jack Astor's. They were both waitstaff, effectively, but they were able to be organized and they put enough money aside to get that down payment together. And I'm going to present them with excellent news. Their property's almost doubled from the time they purchased it, right? So it's an incredible story. It's an incredible way to generate wealth, but you have to be dedicated and you have to be willing to make sacrifices today for the long-term payout and to reap the rewards later on, right? It's what can you give up today in order to kind of generate those rewards down the road. And I remember even in my youth, the amount of hours I was putting into the business and working and missing certain events and whatnot. Would I have liked to have been there? 100%. But it just didn't work. I had to be working. I had to do other things. So there's going to have to be some give and take and some sacrifices. And obviously, if the sacrifice is, I don't want to make those sacrifices and therefore I'm okay not buying a house, then fantastic, no problem. All the power to you. But it's not as easy as it was for our grandparents. I completely understand that. Sitting down and moping about it isn't going to be the solution either, right? So it's how can we find a middle ground to actually get us to where we want to go and make that dream of homeownership a possibility, because it is still feasible. And it might not be a home that you're going to live in. It might be an investment. You might buy a property that's 35 minutes outside of the city that you're still getting a great deal on and that it's in great condition because it's a new build even. You can rent it out, start building some equity. Those neighborhoods usually appreciate even more because they're newer neighborhoods that have a lot more upswing to them. And then in a couple of years, you might have enough of a down payment or an equity buildup to use the down payment into a property that you're actually excited about and that you want to live in, right? So there are things that can be made to kind of mitigate this and to get into home ownership one way or another.
Yeah,
I think also there's...
Sorry, Robin. You really need to educate yourself. And you need to talk to experts. And now I'm going to toot our own horn, but call Fred and myself. Doesn't cost you anything. And we'll walk you through all the ins and outs of mortgages, and then call a guy like LJ and say, what's on the market? What do I need to do? And how do I get into the market? And how do I buy my first property? You're about to make the biggest investment that you're ever going to make in your life, and you're going in blind. So do your homework, educate yourself, devise a plan, put money aside, and don't go out to restaurants 7 nights a week if you want to buy a house. Cut down your expenses, and analyze what's on your credit card. Analyze where you're spending your money. And more than likely, you'll be able to put some money aside. It may take some time, but that time is well worth it, because the best way, and we say it time and time again, to build wealth is to buy a residence, your principal residence. If ever you sell it, whatever it generates is tax-free, and there's no other investment in Canada that is tax-free. In other words, you're not going to pay capital gains on it.
I feel like there's also just a lack of education. If your parents aren't teaching you this stuff, if your parents don't know this stuff, then you're not learning it in school. I remember my economics classes in high school, and the only takeaway I can really recall is like the difference between macro and microeconomics. We weren't learning about interest rates. We weren't learning about leases, mortgages. This is actual real world information that would be useful. I don't think it's all that necessary to know the difference between macro and microeconomics for year 16.
It's so funny, Robin, that you bring that up, because I was talking to a colleague of mine, and back in the day, there was home economics, and it was taught in school, right? I think we should do one of our shows and pick 4 subjects for the 4 quarters of our show and talk about home economics. I mean, it's probably a little bit off our mandate or off the direction of this show, but it is so important. It's all under one roof, exactly. So I think I propose that we pick 4 subjects, and we should let the audience say, hey, guys, can you talk about this, do some research on this, and propose those 4 topics to us, and we'll do an in-depth show on home economics.
I love that, because I took home ec in high school, but it had morphed into something really bizarre. Part of home ec was learning how to bake a pie. It was like,
I was going to say how to scramble eggs.
Yeah, I remember one of the classes was on sewing, and everyone in the class made a pair of boxers, whether you were a woman or a man. That was what we learned how to do. Like, these were not economics at all. These were like how to be a housewife 101. It was not.
No, but it's the value of a dollar, proper use of credit, paying your taxes, paying your income taxes. Creating a budget, really, drilling down on what you're spending your money on, and are you really spending your money on the right things? And I don't want to sound like an old guy going, oh, I told you so. But you know what? I'm the son of a Scottish accountant, and he always taught us the value of a dollar. And fortunately, we've never had any financial issues. There are 4 of us in the family, and of all of us have always lived within our means, and all of us own our own homes today. So Dad did well by us, and he taught us, his way of home economics. Don't spend it if you don't got it.
I think a lot of young people get discouraged. And when I say young people, I'm talking Gen Z and millennials. So kids who are in their 20s and 30s. Because sometimes you read or hear from financial experts who say, stop eating your avocado toast, stop getting a latte. And they're like, okay, I do that once a month. So it adds up to $100 a year. Great. I can save up for a down payment by the time I'm 300 years old. So I think sometimes people hear that advice and it feels out of touch. Do you think that there is maybe a different way to connect with these young people instead of condescending to them?
No, it's not condescending. Listen, LJ and I and Fred, we just worked on a deal, and she is 22.
Wow.
And I think he can't be more than 26. They just bought a revenue property that they're going to be living in. They came up with a down payment. They did the math necessary to make sure they could afford it. And they're not earning oodles of money, but they're now sitting in a revenue property. It's a beautiful place, fully renovated. It's got an outdoor pool in the back, and they paid a decent price for it, and it's going to be a terrific asset. And they got the bug for it. LJ mentioned, I know they're going to call us back in 3 to 5 years and go, okay, there's some equity in this house. We have got some great rentals. Let's flip that into a 2nd, 3rd, 4th, 5th property. And they're building their retirement. It's all about passive income, right? At the end, you're hoping that everything's paid off, and then the money just comes in because people are paying rents on the properties that you've invested in, and those properties are mortgage free. So the money that's coming in, obviously you got to pay tax on it, but It's coming in passively, which will finance your retirement.
And this is, I mean, just to give a bit more color commentary and just to highlight what this is, two people who combine, I believe the income was about $100,000 combined, right? This is two salaries of about $50,000, shifted however you want, but effectively there really wasn't a large, crazy income generating couple. This is your average Joe by all intents and purposes. Any people, I mean, and they're even young to be making those salaries to a certain degree, right? But anybody closer to 30 years old, generally speaking, if they have been employed for 5+ years, they're at about $50,000 a year. You know, that's a relatively common income. So if you can be disciplined and you can make the budget and you can really prepare for this, then you can line things up, right? And you know what? Maybe we've spoken about borrowing from parents or getting gifts from parents. Maybe you can't get a gift from your parents, but maybe they have a home equity line of credit. And maybe they're willing to let you use the home equity line of credit so long as you make yourself responsible for the interest on it and the payments on it. And a lot of people who haven't been able to save necessarily or save as much as they need to, they might have enough for closing costs but not down payment or something of that nature. Well, if you can really tighten your belt a little bit more and you can take on that additional loan in order to make this happen, I'm sure your family members will be quite inclined to allow you to use some leverage that they have available to them, especially when it's going to be backed by an asset, right? You're buying a property here. You're not going to spend it on, I don't know, some sort of fun event, right? So it's just thinking about being creative and doing something different in order to get yourself into that property.
So you should use the home equity line of credit to buy Taylor Swift tickets, is what you're saying.
Well,
that's a once-in-a-lifetime opportunity.
That's an experience. You got to do it, right?
Yeah.
If it was on the news and, you know, it's going to generate almost $300 million in economic impact in Toronto, and the average Taylor Swift concert goer is going to spend $1,800 to go to that thing. But if we come back to the survey, despite everything that we've just said, 58% of young people still plan to buy a home within the next 5 years. So there's still hope. And I really believe that if there's a will, there's a way.
If you're curious about what you need to do to be able to buy your first home, give LJ a call, 514-500-4040. Up next, our property of the week, plus what we learned this week and the answer to our trivia question. That's coming up after we check traffic at the CJD 800 Traffic Center. You're listening to Under One Roof MTL on CJD 800. I'm Robin, that's LJ, that is Martin, and we are with you until 1 p.m. Our property of the week. There's always so many great properties in Montreal. You just need to know where to go to find out about them. And LJ's a pretty good guy to ask.
This week I want to highlight a property that we have that's come back onto the market now. It was on, then we took it off, but finally we're back onto it. We're ready to make this move. So if you're looking for a unique investment in the heart of Montreal, check out 807 to 809 Rue Rachel East, a stunning mixed-use duplex in the vibrant Plateau Mont-Royal. For $1.1 million, this property offers a spacious commercial space with a full basement, plus a 4-bedroom residential unit just above. That unit is even spread out over 2 floors, so kind of that townhouse living feel, if you will. The property is just steps away from Parc La Fontaine, which is one of the largest, most beautiful parks that we have in Montreal. Has volleyball courts, cross-country skiing, ice skating ring, baseball, you name it, they have it. You have tons of trendy shops nearby and tons of dining options available to you. The property is perfectly located for businesses and living. The current owner actually has their business on the commercial floor just below. So if you're looking to have something fully integrated, this could be an excellent option for you. Don't miss this one-of-a-kind opportunity. Book your visit today. And for your next favorite part, Robin, my go-to restaurant in the area would have to be L'Express, an excellent French bistro that is open late until 2 a.m. Try their French onion soup or the beef tartare with a nice glass of red wine.
My recommendation about L'Express, sit at the bar.
That's my recommendation for most restaurants. Like, that is a really cool spot.
There's something special about sitting at the bar at L'Express.
Yeah.
Because you never know who's going to be sitting next to you. And also the bartenders or the waitstaff are very entertaining. So,
yep, that's how they make their tips, right? You got to be entertaining and take good care of your regulars. Let's get to the answer to our trivia question of the week, brought to you by Felix and Norton Cookies. Our question this week was, what is the process of multiple buyers competing for a property, driving up the price, commonly known as? It is a bidding war. A bidding war. Yes, which, LJ, are we seeing a lot of bidding wars these days in Montreal?
So in the sub $600,000 price point, we've definitely started to see a lot of bidding wars. One of my colleagues, Nikita, works with a lot of first-time buyers in that price point, and every week he comes back to the office on Monday and said, "All right, how'd your weekend go?" Submitted 2 offers, 1 offer, whatever it may have been. There was 6 competing offers, 8 competing offers. I think one property recently received 22 competing offers. Now again, it really is price segment categorized, if you will, because in the higher price points, we're not seeing too much multiple offer situations yet. And again, it isn't everything. It's really interesting properties that are clean, that are good condition, that are move-in ready. Those are the ones that are garnering some of that multiple offer interest.
So LJ, if you're confronted with that, because I've seen some real estate agents saying, have your bid in by 5 p.m. on Wednesday, and then we're gonna pick the one that is gonna get the accepted offer on Thursday morning. Is there anything you can do to work around that? And I'm going to stack my question. Do you recommend that home buyers, as soon as they find something, not to dilly-daddle, and to just make an offer and get on with it?
100%. I like to have, and I encourage our clients always, we want to have that first mover advantage, right? So if we like a property and we saw it whenever we saw it, let's get our offer in as quickly as possible, because what that does, and my strategy here, is that if there are any tire kickers or anybody who wants to come in with a lowball offer, they're usually going to be discouraged by the fact that there's already an offer on the table. So at least I'm going to kind of put our chips in immediately, and that way we're going to get rid of the people who might not be so serious. But if we had been going into this property and there was already an offer on the table that may have been from a lowball offerer, if you will, then we're not at fault. We're not at risk. We don't have to worry about it. And we can really move forward with our strategy right away, because we approach a property very, very differently when it's a multiple offer situation than when there's no offers on the table, right? Our initial offer versus our best and last are the 2 different approaches. So always, 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 we want to have that first mover advantage whenever possible.
So what happens if you're in a situation where, thank you for your offer, but we're going to wait for them all to come in at 5 p.m. on Wednesday? How can you manage your client, and what strategy do you use to try to make sure that your bid is the winning bid?
Communication is the first thing. We want to make sure we're communicating with the listing agent throughout the entire process. The more we speak to them, the better chances we have of having the right results. I find that in 2024, a lot of brokers have forgotten how to work in that sense and aren't necessarily taking the time to communicate with the listing agent, build that rapport, build that relationship. And in doing the little things, it's not that you're going to get more information out of them, but it's simply, hey, everyone likes to collaborate with people who know how to pick up the phone, who know how to reach out, know how to have conversations. So it just makes that process a little bit smoother. Obviously, we prepare clients. If they don't want to answer, if they've told us outright they're not answering before Wednesday 5 p.m., then we know going into it, there's a pretty good chance they're not going to offer. Now, sometimes the offer is good enough that the seller says, hey, I don't want to miss out on this, and they're gonna make the move. But in general, even if that's the case, I'm happy to submit that offer right away and be the first mover in, and knowing that typically, okay, if there's nobody else, we're submitting, let's say, an offer at asking price, let's say, was $500,000. We might go in at $480 in this case, but we know that our best and final is maybe $515 if there is multiple offers. So we approach with that $480 to start, and once the other bids come in, then we kind of enhance our offer to our best and last.
I got one. Do I have time for one more question, Rob?
For sure.
What about conditions? If you take off some of the conditions in your bid, does that better your chances of winning the bid?
So 100%, right? Whenever anybody's analyzing an offer, there's a couple things they're looking at. They're looking at the price. They're looking at the down payment. Is it cash? Is it a financed offer? So do we have to go through a mortgage approval? Is there an inspection condition? Is there a document review condition? Are there any additional conditions? What were the dates for the occupancy and for the notary signing? Those are the typical points that we're looking at, right? So you can remove some of them. Now, again, we don't recommend removing that inspection condition. There is too much to learn about a property. It's too large of an investment to go into it blind, as I say. But in some cases, sometimes for a single family home, for example, we might remove the document review condition, because what are we reviewing? We're reviewing the tax bill, which we can usually find online. We sometimes ask for recent renovation receipts. Sometimes those are already available. Sometimes we can ask for them in goodwill, but not make it a condition. Sometimes we ask for a copy of their insurance bill just to understand what their premiums are. But even at that, obviously, every insurance really varies from person to person, not so much for the property. So that's one condition that sometimes we play around with removing because we can get the information preemptively, but I really don't like removing the inspection condition. Unless I have a report from an inspector that I trust done in the last 6 months, it's not something we're generally going to discuss playing around with.
What about something like conditional on the sale of my current home, That seems to be a very weighty one in the sense that, that is a huge condition, because then it parks the house that's being sold until the owner sells, or the bidder sells his house or her house, to then use the money from the sale to purchase the second home.
So making an offer that's conditional to the sale of your home is something that we see depending on the market, right? So over the last year, we've definitely seen a bit of that happening. Now, it isn't necessarily detrimental to the seller, simply because they still have the right to sell the property to somebody else. They have the right to continue to offer the property for sale. So it isn't a one and done, like all of a sudden nobody else can jump in.
Guys, I learned so much this week, as I usually do. First of all, if your mortgage is coming up for renewal, find out what your options are. If you're one of the 1.2 million Canadians who is going to have to renew your mortgage, get in touch with Fred and Martin so that they can walk you through your options. Fixed rates offer stability. Variable rates will probably save you money, but it's a bit of a gamble. And home ownership, while a lot of young adults think it's just simply unattainable, it is possible. Where there's a will, there's a way. You don't need to be super rich. You don't need to be earning a ton of money. You don't need to have parents gifting you down payments. There is always a way to get into the market if you're willing to sacrifice. That's pretty much it for us for this week. A reminder that Under One Roof MTL can be heard live every Sunday at noon right here on CJD 800. If you want to learn more about the guys, visit the website underoneroofmtl.com. In the meantime, get in touch with LJ, Fred, and Martin individually. LJ, where can people go to reach you?
Check out our website, ljrealties.com, or on all socials with the handle LJ Aguinaga. That's LJAGUINAGA, or LJ Realties, IES at the end. You can also call or text me at 514-500-4040.
Martin, where can people get in touch with you and Fred?
Best way to reach us is through the website, fredmartin.com, fredandmartin.com, fredandmartin.com.
Wonderful. Did you get that? Fredandmartin.what?
.com.
If you missed anything, you can listen to this show in its entirety on iHeartRadio, Spotify, Apple, or wherever you get your podcasts. For LJ, Fred, and Martin, I'm Robin. This has been Under One Roof MTL.